The rupee is falling. The market is crashing. You have probably heard these two headlines together hundreds of times. But here is the question. Does the weaker rupee actually cause the Nifty to fall? I have analyzed 10 years of data, and the answer is far more interesting than most headlines suggest. Here is where most people get confused. They are looking at price level, not returns. Over the last decade, the Nifty climbed from 8,000 to over 26,000. At the same time, the rupee moved from around 63 to 84 rupees per dollar. So, on a long term chart, both appear to rise together. But traders don't trade price levels, they trade daily and monthly returns. And when you compare returns instead of prices, the relationship changes completely. Over the last 10 years, the average monthly return correlation has been around negative 0.38. That means the rupee and the Nifty have generally tended to move in opposite direction. Not always, but often enough to matter. So, what is driving both? Three letters: FII. Foreign institutional investors. When foreign investors buy Indian stocks, they first convert dollars into rupees. That strengthens the rupee. At the same time, their buying pushes the Nifty higher. When they sell, the opposite happens. They convert rupees back to dollars. The rupee weakens, the Nifty falls. So the rupee isn't causing the market to move, and the market isn't causing the rupee to move. Both are reacting to the same driver called foreign capital flows. But here is the twist: the relationship isn't constant. Take India's IT sector. Companies like TCS, Infosys, HCLTech, and Wipro earn a large part of the revenue in US dollars. When the rupee weakens, those dollar earnings become more valuable in rupee terms. That can support IT stocks. And because IT has a meaningful weight in the Nifty, the index can remain strong even while the rupee weakens. There is another reason too. Sometimes the rupee falls simply because the US dollar is strengthening globally, not because India's economy is weak. In those cases, the Nifty may barely react. So the next time you hear the rupee is at an all-time low and the markets must fall, ask one question. Why is the rupee weakening? Is it because foreign investors are pulling money out? Or is it just a stronger US dollar? That's the difference between following headlines and understanding markets. Data doesn't remove uncertainty, but it replaces assumptions with evidence. If you like this video, do subscribe and like. Free equity analysis course link in the description. Thank you.